Matt, you're a fool for buying the dip of a dip of a dip of a dip of a dip. Can't you see? You look at the 1-year chart. Can't you see that the stock has been going down? It's not a good deal. Why do you keep buying? I'll explain it in 2 ways. Here's how Tesla stock looked a year ago. It was pretty good. Looks very attractive to me. But as things have come down, you have to admit the temperature just increased a little bit. Things are getting hotter, more attractive. It's as if the earnings in a red here for next year just kept increasing or something. It is all natural beauty. It's all organic profits that we see with Tesla. So things have gotten much more attractive. When Tesla stock looks this good, how can I say no? And then there is this other argument that says, you have no idea how short I am. This is from Michael Burry, the guy who predicted the 2008 crash and made a ton of money from that. But to this I say, lies. We know exactly how short you are. Everyone is talking about recessions and worried about recessions. Well, how about this? Have you seen this? The longest recession that we had since World War II was 18 months. And that was the 2007 to 2009 recession. Recessions don't last more than a year usually. And many say that we are already in a recession. So how much longer will this last? I believe certainly not forever. So I am buying the dip of the dip of the dip of the dip. Also, when recessions do happen, we see an average drop of 29.2%. The market was already down 25%, sort of reaching that average 29-ish%. Check this out. This is the Magellan Fund, and as you can see, it beat the market by many times. This is S&P 500, only producing a tiny return, and this is many times more. And of course, you would expect an average investor who invested in such a fund to have made a ton of money, right? No. During these some 15 or so years, an average investor actually lost money. During this period, the fund returned around 29% annually, which is, by the way, also 29% is Tesla's return on capital invested. Return on capital invested. How can this be? How can you be so dumb to lose money when you invest in such a great fund, while this fund is having incredible returns and you lose money? And the worst part is, people just don't learn from history. They don't study it, not enough. They keep making the same mistakes. And here's one good reason why even the most successful people, the smartest people, cannot really outperform the market when they try to time the market. Half of the S&P 500 index's strongest days in the last 20 years happened during a bear market. Another 34% of the market's best days took place in the first 2 months of a bull market, before it was clear a bull market had begun. So you just miss the timing by just a little bit, and you watch your returns evaporate. Stupid. And we laugh at hedge fund managers that cannot beat the market over a long period of time. In 20-some years, not more than 9 out of 10 of them cannot beat the market if they trade actively. Although in the short run, they may appear like geniuses. But in the long run, it doesn't work. But this is even worse. While the market, S&P 500 returned 7.5% during these roughly almost 20 years. Average investor made 2.9%. That's just inflation. So then hedge funds trade because they do have a lot of research and a lot of knowledge and everything. When they trade, at least they don't make spectacularly dumb decisions where they just match inflation basically. They still underperform S&P 500 in the market, but it doesn't look nowhere near as bad as just an average investor being at 2.9%. So this is one big reason why I am buying the dip of a dip of a dip of a dip of a dip of the dip. Warren Buffett has achieved a 20.1% annual average return over a 57-year period. He does not time the market. He just looks at a company. Do I like it or not? As long as the stock has a pretty face, it does not matter how many clothes the stock is wearing. Although, the less the better, of course. All I am worried about is the earnings, the profits. I see them going up, and then usually the stock price follows along. Sometimes it does silly things like it did right here, and sometimes it drops a little bit below and maybe quite a bit below. And right now, it's just in the absolute silliness category, which doesn't make sense to me, which it's reasonable that the stock market is a little bit crazy right now, but long term, my deep conviction is, of course, not financial advice, that the stock price will eventually catch up with the earnings. The Citi analyst who perhaps made the Tesla stock, go up quite a bit when he changed his rating from sell to now neutral, he projects, if a stock does not change from where it is right now, that next year, in 2023, Tesla's PE ratio would be 30. For example, Apple's price to earnings ratio is 24-ish right now. Amazon is at 86. And then you look at their net income growth, and you see Tesla has grown 100% year over year in Q3. Then other companies, only Apple grew just by 1%. And what else do you need to see? Tesla is extremely lean. Tesla's revenue keeps growing and is projected to keep growing by a wild amount, while operating expenses have not even doubled during this period, while the revenue went up almost 8 times. This is mind-blowing. You compare Tesla's operating expenses as percentage of revenues to other companies, and it does not look very good. I mean, can you see why I am buying the dip of a dip of the dip of a dip? Nothing fundamentally has gotten worse. It's just the macro environment and the whole situation with Twitter that is distracting everyone. That is all just noise. The company has not changed. And if you are timing the market, sure, short term, maybe you can outperform the market. This is Bridgewater in blue, the number one biggest hedge fund in the world. And in the end, it produces the exact same results as the market. The only difference simply is it's less volatile. So when the market goes up a lot, it doesn't go up. But when the market goes down, it does not go down much, if not at all. It's just a much smoother ride in which I see a lot of value if you are close to retirement. But if you are investing long term, and if you are just an average retail investor who does not spend all of his or her time looking at the markets, You do not want to be an average investor making just 2.9% because you are trading. I personally, for myself, prefer the Warren Buffett way, where I find companies that I really like, I concentrate my money, which, by the way, this is one huge advantage that we have over those big hedge funds. Imagine if Ray Dalio dropped $100 billion on Tesla stock. I mean, Elon sells $4 billion of Tesla stock, and the stock just tanks. So they cannot have these huge positions easily. But I, as a retail investor, my net worth is over 10 million. I'm not worth billions of dollars. I can put a lot of my money into a stock and not worry that the stock is going to go up simply because I am buying, or when I sell, worry that the whole stock will tank before I finish selling. We do not have that problem. So I like Warren Buffett's way, where you find stocks that you like and you do not care about what the market is doing. You don't care about what the Fed is doing. You don't care about any of that noise. You just pick the stocks that you really like, as long as you think they are attractive at the time when you bought them. If a stock goes down, you just buy more. Very simple. I invest in Tesla stock because of full self-driving, and everything else for me is an insurance policy to not lose money. That's how I invest in Tesla stock. So I liked it a year ago, and now I really love it. It's just getting better. So that explains why I am buying the dip of the dip of the dip of the dip of the dip, and why I will continue doing so. Those are 48 reasons why I only own Tesla stock. My name is Matt Posius. I will see you right here. Like and subscribe if you haven't yet. Thank you for watching.